Well, hello, everyone. Welcome to Trading a Smaller Account. My name is Barbara Armstrong. I am a coach and senior manager with Schwab and delighted that you are joining me for Trading a Smaller Account. If you are not following me in the land of X, consider this your formal invitation at Barbara Armstrong CS. We also have the privilege of having Mr. Kevin Horner in the chat. He has thawed out after yesterday's Broncos game in Denver, where he, bravely cheered through like 2-degree weather with the wind chill, according to my phone, as I was watching the fourth quarter. So he is with us. He's a great guy and an excellent coach. So if you have any questions, don't hesitate to ask. And you'll want to follow Kevin too in the land of X, Kevin Horner CS. So what are we going to talk about today? Friday, we did a bunch of very directional trades. We are out of some of those positions already. We're going to have a quick look at how those worked out. And then today we're going to talk about something that is still bullish, but a little more neutral. And why are we doing that? Well, one, the first few stocks I looked at, were candidates that lent itself to that type of strategy. But also, this is a class where we're looking to learn. And so today we're going to talk about short put verticals. Friday, we talked about stocks and short-term targets using calls and stocks. Just a little different thing on the menu today. So we're going to review 3 trades that we placed Friday that have already hit targets. And then we're going to look at least 4 new example positions, all using the same trading strategy. So today will be short put vertical day. That's what's on the menu. And we're going to look at why we might do a short put vertical as opposed to a swing trade, or as opposed to a long call vertical. So okay. So, and I want to thank, before we get into the thick of things, all of you who continue to show up each and every week. If you're here for the very first time, feel free to type a greeting into the chat so we can welcome you. But to Josh and Will and Niru and Ron and Jay and JDLMI and, Jack and Bill and Made with Love, like some of these handles are just great. But I thank each and every one of you for being here. Chris and Paul, you guys win the prize for being the first into the chat. And AP514 always checks my math for me, so I appreciate that too. Okay, so let's keep in mind that options carry a high level of risk. We're going to do a bunch of options trades today. That's not suitable for all investors. You have to apply for option trading privileges. So if you are here for the first time and you're new to all of this, you can, we use the paperMoney software application on the thinkorswim desktop platform, which is a brilliant place to learn. And you can trade anything you want in that account. You can put as much money as you want in that account also. But know that there are some nuances and differences. One is that short option positions will never be assigned early in paperMoney. So we get to discuss that, but we don't get to see examples of that in paperMoney. That can happen in a live account. Have I had it happen? You bet your sweet Bippy I have. And the first time it happened, it was with a short put vertical, and it kind of freaked me out. So we'll talk about, what the your choices are, should that happen to you, and how you might take steps to try and prevent that from happening. Okay, so but know that everything we talk about here is for general information purposes only, none of it to be construed as a recommendation. We're going to just do a bunch of examples. So Kevin Horner does a fantastic class first thing in the morning called Trader Talks. He was there this morning. If you missed it, I encourage you to put that on your schedule to attend. It's every day of the week except Tuesday. And so my market overview is going to be really, really skinny. And then we're going to place a bunch of new example trades, and we don't really have anything to manage per se today, but we're going to review 3 of the trades that we placed on Friday that hit their targets first thing this morning when the market opened. Now, there are some new people here, so I want to welcome you. So congrats for being here. Oh, I didn't update this. We started this year with 25,000. Our max position size is 5,000 if we're buying stock. or doing a buy right covered call. This is an intermediate level class. We do place a lot of example trades. It's a very active trading class. So, this is 20% of our account size. Now, if you had a $1 million account or a $500,000 account, you might say, I don't want my position size to be more than 5%, and that's legit, but you should, pick a number. And then our max risk per trade is 500. And our focus here is on the short to intermediate time frame. So we talked about goal setting at the beginning of the year, the very first class of the year, which was January 2nd. And so if you miss that, you'll want to go back and catch that. And kind of our idea for this year, we said, well, if we had a $25,000 account, and let me go over to that account. If we had a $25,000 account, what if we set a goal to try and make $100 a week? That would be a good goal. Or a great goal might be to make $200 a week. And so far, like, we are screaming way ahead of that goal. And so, should we be concerned? And this is what I say when I think we've had one trade that it was a losing trade so far. And is that typical? No. I went to Maui, 2 years ago, and the market had this big pullback and I couldn't even get into the paperMoney account. And, we had a whole pile of long call vertical trades on. We were down $2,500 in 1 week in this class. So maybe, why do I mention this? I mention this because it's easy to get cocky and to start to think like, wow, look at us. We're up over 10% and the month of January hasn't even closed yet on our total account value. But what the market giveth, the market can taketh away. And I say this because sometimes the voices in our heads start to say nasty things like, hey, you know what? This position sizing stuff, this is for mere mortals. Obviously, we are brilliant. And so we shouldn't be, we should be doubling that position size because we could have made so much more had we placed bigger trades and risked more. So, and if you start thinking that way, go wash your brain out with soap. I don't know how you do that, but become very concerned. Because that's when something happens and all of a sudden you have 10 trades go wrong and, you're laying on the bed in the fetal position, sucking your thumb. So we continue to honor those position sizes. We're not going to risk more than $500 on any one trade. Okay, I'm going to get off my pedestal now. Okay, so here's our S&P 500. It is within a hair's breadth of hitting a new all-time high. So it's hard to look at this chart and think it's anything other than bullish, right? And how about the NASDAQ? This is our tech-heavy index, no financials. But, it's been setting up a bit of a panic pattern. But again, here's our all-time high. And, we're in the hood. We're in the same neighborhood. So, but what will be interesting to see is if it breaks above this similar high. But, we're up 0.7% so far today. How about the Dow? Well, the Dow close to an all-time high, just continuing to walk up the hill. I don't know why that line is there. And really, this line's no longer relevant either, so we can get rid of that. And then how about our small caps? And the Russell 2000, this is the smallest of the Russell 3000 stocks, the 2000 of the smallest. And, we've got a bit of this could be a bull flag setting up. But, 2 trading days ago, so Thursday, this hit a new all-time high. So pretty bullish, right? Right. And how about the VIX? Well, it's down around 1590, kind of in the same range it's been in for a lot of the last year. Okay. So let's start by reviewing a trade we did Friday. And again, one of the things that we've said is let's go for little wins. And then are we going to beat ourselves up if it could have been a bigger win? We are not. And why is that? Because we agreed when we placed the trade that we would be happy with a small win. So on Friday on Anglo Gold, ticker symbol AU, we did 2 trades. At least I think that was 2 trades. We bought a call and then we bought a bunch of shares of stock. And we had a conversation about where we would put our stop. And I think we put our stop down here. So it only allowed us to buy a few shares of stock. I think with this one, we bought 33 shares. Okay, so, and our target was 1 ATR. And what is ATR? ATR, and I've added this to the bottom. If you don't have it on your chart, you can come to studies and edit studies and then just type in ATR. It's right at the top of the alphabet. So it's going to show up. And then just add selected, apply, and okay. I've already got it on my chart, but we said, hey, if in an average day, this stock moves about $4, and here was our example. Oh, excuse me. If it moves about $4, if it goes up $4, we'll take the money and run. And that $4 was 108.59. So this morning it opened above that and continued to run. But we got out. If we look at this, that was the other trade that we did. Both of them gold. So we bought our call at 110 and we got out when the market opened at 733 for 670. And so, we're going to call that a win. In 1 trading day or in 3 calendar days, and we're just taking this 670 and we're subtracting the 440. So we were ahead by $2.40 or $240. Now, how much were we risking? We were risking $440 because we bought a call. And when you buy a call, how much could you lose? You could lose the entire amount. So when we look at what was our return on our risk, it was 52%. And that's just not too shabby for a trade we were in for 1 day. And is this typical? No. No, it is not. But we're going to call that a nice base hit. And we made $240. Now, we aren't taking transaction fees into account. We paid 65 cents to place the trade if it was in a live account, and we would have paid 65 cents to get out. Now, what about the stock? And why did we even do a stock trade? Well, we have, 23 of our 28,000 is sitting here in cash doing, ding qua qua, or doing a whole lot of nothing. And so if we look at that and we said, well, why not put some of this money to work? And so we bought 33 shares at 104.61. And this morning at 7:31, because our target was the same, we got out at 109.48. And so if I subtract one from the other, we were up by 459, or sorry, just a minute, $4.87 a share times 33 shares. So we made $160.71. And so we're going to call that a win also. Now, what was our return on risk on this? It was 487 a share is what we made. And what were we risking? Now, we had put a stop in, but technically if it gapped down to 0 overnight, we could have lost that entire amount. So I'm not going to use the stop loss. We're just going to use the price of the stock, which is, and so maybe instead of saying return on risk, this is how much we had invested. So maybe instead of ROR, we call this ROI because we invested $104.61. So that's 4.65%. And you might say, well, obviously then it's better to do the call where we made, the total amount was more. And as a percentage, it was certainly more. But if the stock went sideways, we could have ended up, losing this entire amount because we don't have to worry about time decay with the stock. And we talked about that on Friday. So if you weren't in the class Friday, you may want to go back and listen to that too. Okay, so that was those two. Well, let's go and look at something new. And if you're not familiar with what a short put vertical is, let's come over and look at the Mall of Wall, the Mart of Wall, Walmart. And we can see that this stock has been uptrending. It's had some ups and downs, but overall it's been uptrending. Now we do have earnings coming up when? February 19th. But what we've seen here is a bit of a consolidation, right? Where this kind of 117-ish level seems to be holding. So could we come here and sell a put and then buy a put below it at, say, 117 and maybe 115? And the idea being here, just if you're new and you're not familiar with a short put vertical, oops, let me get rid of all that mess, is we're going to sell a put. Oh, sorry, didn't mean to go yellow smello. So if we sell a put, what are we agreeing to do? We're saying, hey, we're willing to buy this stock at 117. If you'd like us to buy this stock at 117, we're happy to buy it. But, you know, and it's trading at 118. But if this bounces and stays above 118, why would somebody want to make us buy it for less? You know, and our expectation is that they won't. And so this would expire worthless. But we can't have a position size, remember, bigger than 5K. And if the stock were put to us, that would be an $11,000 position. And that's bigger, and you know, than we're willing to take. Plus, there's the risk if it gapped down, we could lose a lot more than the $500 risk cap that we have. So what we're going to do is buy a put. And when we buy a put, it gives us the right to sell the stock. And so if we did this at 115, we now have the right to sell the stock at 115. So the most we can lose is the $2 in between, less whatever we got paid for the trade. Okay, so that's a quick and dirty on what a short put vertical is. And, you know, unlike a lot of other trades, and if you started with stock investing like I did, you buy something lower and you want it to go higher. This is, we're selling something and we want it to expire worthless. We want it to go down in value. So earnings is February 19th. We don't want to trade this over earnings. And I know some people would do this as an earnings trade. So we're going to put our expiration date in 18 days, which isn't a long time. We've got 5 million shares traded today. So I'm going to show you where I have put an example trading plan. It's about 20 minutes long, this little video that walks you through it. But one of our guidelines is we want the stock to trade more than 1 million shares a day. We want there to be 20 times at least the number of contracts we're thinking of trading. We want the bid-ask spread to be less than 10%. And we want the delta to be in that kind of 20 to 40 range. So we're at the top end of that. But if we look at selling this vertical and say we make it $2 wide, we get 64 cents. Now, another guideline we have, so how much are we risking? $2 minus 64 is 136. So if I take 64 and divide it by 136, one of our guidelines is if we're in it for 18 days, we want to get at least 18%. In fact, if we can't get at least 20% to 25% on a short put vertical, we won't place the trade. And this is potentially a 47% return on our risk. And so how many of these could we do? And time decay is going to be working in our favor. So I'm going to come here and put in time decay. And we can see here that we're losing 10% a day of the value of this just by the ticking of time, you know, which helps. Okay. Now, what doesn't help is that we're approaching earnings, and that as we approach earnings, volatility can go up. Okay, so the other guideline we have is we said, just as an example, some might say, well, I'm planning to exit this when I have 80% of my max gain. So we're risking 400 here for the opportunity to make 195. So what we're going to do is change our advanced order to first trigger sequence, right click anywhere on this order and say, hey, when this is worth about 13 cents, when I've got 80% of my max gain, now some might want to make it 90, some might say, hey, if we met Wednesday and we were up, 50%, we might just take that. Just because you put a target in doesn't mean you have to stay in to the bitter end. So we're risking 400 and we've got our target in there. Whoops, it's not short puts. We're going to put it in our short put vertical bucket. Okay. Why not do twice as many dollar wides? And you could do that. So I like this question because I was going to discuss this on the JP Morgan trade. So here's another example where we've had a stock, JP Morgan, which has been kind of trading in a sideways range. It's come out the other side of earnings. So it missed a little, but what are the analysts saying? So these guys have adjusted their price target to 397 from 386. So they've raised their price target. 397 is so much higher, it's off the charts. So, and that doesn't mean that analyst is going to be right, but it just kind of gives us maybe a little bit of a sense. And it looks like post earnings, although this did come down, it looks like it's found a support level. And it's a support level that it has found multiple times. It spent a couple of days here, and then a couple of days here, came down into the neighborhood again. So this is the fourth time it's come down around this 295 level. And then what do we have today? This candlestick pattern is called a harami. So today's candle body is inside Friday's candle. And this is a candle pattern that is bullish when it occurs at a support level and does not require confirmation. And by that, I mean that we, from a technical analysis, candlestick definition perspective, one might not have to wait for the next day to see it trade higher. This is a tradable pattern in itself. Now, that doesn't mean some people might not want to wait. Okay. Okay, so if we come to the trade tab and we say, well, it's sitting at 300, would there be enough premium? And for this, we're on the other side of earnings. So if we come out 25 days to this 295, we have a 20-cent bid-ask spread. That's about 5%. So check. How are we doing with volume? Like thousands of contracts here. So we're good there. Delta of 35. So this, this is probability of in the money. So with this, we've got a 37% chance of it being in the money at expiration, which means we've got a 63% chance of it expiring worthless. And this is based on a mathematical formulation, the likes of which is above my pay grade, but it doesn't take technical analysis into account and the fact that it's come down to this 295 neighborhood multiple times in the last few months and has not crossed below that. This is called a bullish harami. And I will show you where to see a bunch of short videos on candlestick patterns. And you're welcome to join me on Tuesdays at 2 o'clock Eastern. I teach a getting started with technical analysis. And we spend a whole class just on candlestick patterns. So if we look at this and we say, okay, if we come out to February 20th, we look at this 295, we're selling a vertical. So if we did the 250 wide spread, dang it, it was 75 cents when I looked at it a little earlier. So if I have a 250 wide spread, which is the smallest spread we can have, would I get twice as much if I made it twice as wide? And The answer is, so that should be 142. We're getting 134. So, you know, if we did 2 contracts and they were successful, you know, and we just let them expire worthless, not that that's our intention, but just for conversational purposes, at $1.44 versus $1.34, that's a $10 difference. That would more than pay for the $1.30 or $2.60 difference of buying 1 contract versus 2. So as Andy said, it's almost never worth going wider. So why do some people go wider then? Well, one, if I go from 292 to 290, the odds of it going through both my strikes and my incurring a total loss is almost 10% less. And so, you know, that might be enough. But some traders would say, well, if I'm really confident that this 295 line, that it will stay above 295, then I'm not going to worry about if it goes below 295. And I'm not saying whether you should worry or not. What you do with your worry is your choice. But this is the rationale behind it, is that the probability, well, actually, this goes from 32 to 27 of the probability of it being in the money. So it's 5% less. But so we're going to do the 292.50 strike. So how much are we risking? Well, we're risking 175 to make 75. Okay, we're going to be in it for 25 days. So if we go back to our calculator and we say, okay, I'm going to go 75 divided by 175. Oops. Let me do that again. I'm a little calculator challenged. Divided by 175. Okay, so that's a potential return of 43%. And so is that more than 25? Yep. So are we good? We're good. How many contracts are we going to do? 2. Why 2? Because if we did 3, it would put us over the limit. Well, maybe just over the limit. Let's see. 525. So if we say, okay, we could do a risk of 525, we're going to come back, single order, change that to first trigger sequence. We're going to right click, create an opposite order, say, hey, when this gets to the point where it's worth about 15 cents, and this is just an example, we'd like to buy it back. Okay. And we could be out skiing or golfing, or for many of you, shoveling your way out of your driveway, and it could hit your target. You know, this in this example trade. So what's the most we can make? You know, the most we can make on this is $225, and we're going to buy it back when it's worth 15 cents if all goes according to plan. So it would be like $45 less than that. You know, base hit. You're never going to have a 100% return. Yeah, so how you create the duplicate order, we're going to do another one. So we're putting that in our short put vertical bucket. But you can, one of the things I did, because I came to this as a client, my friends. So what I would do when I was watching is I'd say, okay, she did that trade at about the 26-minute, 27-minute mark. So I'm going to go back and watch this again. Okay, so, but let's look at door number 3. We've got a couple of them. How about Citibank? Notice that financials seem to be in lining up for us, because a lot of the financials have come with their earnings. Okay, so we see, and if we come and we look at the live news, like, so, you know, we're looking at technical analysis, but we may also, we're just on the other side of earnings. Like, so this morning, very early, Goldman Sachs adjusted their price target on Citigroup, 134, again, way at the top of the chart from 129. Now, are they the only ones? Let's see. We can scroll down. And, I'm just looking for changes in price targets. So these guys are saying they maintain RBC, the 121. Oppenheimer raised it to 144. That's not even on the chart, 135. So people seem to be, pretty bullish. People aren't lowering targets. And that's kind of what we're looking to see, right? And it's not that these guys are going to be right, but this is what they do for a living. So if we say, okay, do I think it could stay above maybe this 112-ish level? Could that we get enough premium? It's almost at 115. It's $3 above that. And again, if we come out to February 20th, we look at this, we've got 662 contracts, delta between 20 and 40. It's at a support level or below where it's been trading, about a 10-cent bid-ask spread. All of those things trades more than 1 million shares a day. So we're looking to sell. And if we do the dollar-wide spread, 34 cents, does that meet our criteria? So how much are we risking? 66. So 34 divided by 66, that smells like 50%. What do you know? It is. It's about a 50% return. That's more than the 25. That's our minimum, to enter. Now, would we get 66 if we went $2 wide, or 68? No, we only get 57. So we're going to stay with the $1 wide. Now, how many contracts could we do? I'm guessing maybe 8, 7. Let's see, how many? 462. That's pretty close to our 500. So if we did 7 contracts, then to change it, single order. Now this comes up on another screen for me, and I can't move it. But single order, it gives you a little drop down. You change it to first trigger sequence. You come up, you right click anywhere on these 2 pink lines and say create an opposite order. And then we're going to say, hey, when this is worth about 4 cents, buy it back. We'd like to close it out. Okay. Oh, 6 cents. So we're going to put that in our short put vertical bucket. Now, if the trade doesn't go according to plan and it goes through both strikes, then, we know we have our max loss. Now, it's interesting because I just thought, hey, if this doesn't go according to plan and it goes through both strikes, I immediately have my max loss. So I may as well just wait for it to rebound. If it breaks a support level, we might just say, hey, you know what? I don't think this is coming back. It's broken a support level. Looks like it might continue to fall. So I'm going to buy this back and exit the trade, because it's interesting. But if this were to happen in the next few days, because there's still so much time left, even though it's through both strikes, we may well not be at our max loss. We may only be halfway towards our max loss. I know. I was shocked when I first started trading verticals in real life and found that. Now, what if it fell and it was getting close to earnings, or if it fell and was getting close to expiration and I got assigned on the short leg? So all of a sudden I'm buying, how many contracts did we do here? Oh, this hasn't filled. Oh, there we are. On Citi, we want to do 7 contracts. Oh, it's saying now 31.5. So cancel and replace 31. Put it in our short put vertical. When you're live in the market, sometimes, things, the prices move around. So, but if we look at this and we say we did 7 contracts and all of a sudden I've now bought over $70,000 worth of stock, and you start hyperventilating because, we only have $24,000 available in the account in cash. And so we don't have 70,000. So what would happen is, you know, you might expect a knock at your door. You really wouldn't have somebody come to your door and say, excuse me, Barbara, but you need to put like another $50,000 in your account. You know, but they would say, hey, either you need to, you know, put more money in your account, or then it depends on your broker. If it's gone through both strikes, you might say, okay, it's now trading at 105. I'm going to exercise my right to sell it at 110. And, you know, and now I've taken the max loss. And so you have choices when you've position size correctly, even if the, you know, worst thing happens, you know, you're still okay. Now, when can you get yourself into big doo-doo, big trouble? Well, you can get yourself into trouble if you don't close it out prior to expiration. And this only has to happen to you once, you know, and then chances are it will never happen again. But let's say that it's expiration and it closes in between the strikes. Well, now this side will be assigned because it's in the money. This sign will expire worthless because it's not in the money. And then if on Monday the stock dropped, you could end up losing, you know, way more than your max loss. So, you know, what you may want to do is not create the situation where this is a possibility. And how do you prevent that from happening? You close it out prior to expiration. And so one of our guidelines is that we always close things out prior to expiration. Okay. Okay, so let me just look. Oh, earnings is February 2nd for C? No, earnings just happened. This is a dividend. This is a dividend. It's not earnings. But thank you for pointing that out. And so the stock might drop a little bit, but you know, earnings has already happened. Yeah. Yes. Yes. So Riceberg said, yes, that happened to me once. It's a good lesson. So what happened to me was I didn't want to pay the nickel. You know, and Ben Watson, if you ever come to a live event, will say, spend the nickel to avoid the pickle. And Ray Kimbrell was one of the first people I ever heard speak on stage about a losing trade. He didn't want to pay the nickel to buy the position back and close it out. And then it dropped precipitously. It was a short put vertical through both his strikes. It cost him $3,500. And I only share that with you because Ray has shared that from stage. So you can either choose to experience that, you know, loss yourself, or have that learning experience yourself, or sometimes we can choose to to learn from other people. And one time I was trading an index and I didn't realize it settled in the morning. My short put verticals had expired worthless, and then the market dropped like crazy that night, like the biggest drop in 50 years or something like that. And I went from max gain to max loss overnight. And I can tell you what, I only made that mistake once. Yeah. So short put verticals, you know, this is a strategy that a lot of people like because it's conservative, and you can be kind of sort of wrong. And what do I mean by that? Well, what I mean by that is that our expectation is that this stock, because it's been in an uptrend, it's pulled back a little bit. Our expectation is that it's going to go up, or at least continue going sideways. And, you know, our strike is at 112. So if it doesn't do that, we have a little bit of wiggle room. And that's what I mean by we can even be a little bit wrong. But as long as it stays above 112, it doesn't have to go up. And because we do not yet have a diagonal resistance breakout, so I'm going to draw my little line here. So it's setting up a bit of a panic pattern. Because we don't have that yet, that might be why we would choose to do a short put vertical instead of a long call vertical. Now, if it breaks above here, and then comes back and retests and then starts to move up again. Might we add a long call vertical then? Maybe Friday will be long call vertical day. You never know. Okay, now I have a couple of things that I wanted to show you. Okay, so let me just bring up my friend Google, and we're going to come to Trader Talks from Schwab Coaching. And, you know, if you haven't hit that subscribe button, if you're new and you haven't subscribed to the channel, this is what comes up. Like whatever is currently being taught is what you'll see. And then if you come to playlists, I want to bring your attention to a couple of things. One, I had somebody asked about candlestick patterns. And all of these minis are in the Getting Started with Technical Analysis, but you can see here, I've got like, 12 in the series now. I guess I need to add my number 12. There's probably going to be about 18 by the time I'm done. But this bullish engulfing and bullish harami, which was the pattern we talked about today, here's a little 5-minute video. So if you want to do some binge learning, on candlesticks, here's a great place to go. And this is called the Trade Management Mini Sessions. Now, if you scroll down, I've got a bunch of example trading plans. And today was short put vertical day. So here's an example trading plan for short put verticals. It's 18 minutes and 54 seconds long. And we walk through how one might construct an example trading plan. You know, and they all will have 5 components. It's like, you know, what to trade, when to trade, how much to trade, when to get out, and then what are your routines. So those 5 components, and we walk through those there. And then the other thing that I wanted to mention, and I think that Kevin has already posted this, but there is a playlist for this class. So trading a smaller account. If you come to that and want to do some binge learning, here was, you know, the first class of this year. If you missed that, setting goals and choosing strategies, you know, because how are you going to know if you're successful? Yeah, I'm going to be at the live event in Bellevue. Connie is set up. And so this is the other thing that I wanted to show you. So we're going to come to schwab.com/Schwab coaching. So I'm going to be in Seattle this Friday at an in-person event. This is how I got introduced to the world of trading. And I just was smitten. Like, it was so empowering to me. And if I can pull it off, I will teach Friday, but I have a sub lined up, but then I'll be back Monday. Okay. So, but if you've never been to a live event, we're going to be in Seattle this weekend, Ben Watson and I and the travel team. And then next weekend, we're going to be in Sacramento. The first day is Intro to Technical Analysis. Second day, Intro to Options. We'll have the coffee on. We'll provide breakfast. We'll provide lunch. Yes, and I will let Connie know. She'll have access to this account so that we can do some follow-up. But usually with short verticals, we're in those longer. We tend to be in those, you know, for more like a week. Okay. So, but this is the in-person events. And then if you want to see who's doing what, when, you know, we have content being taught all day long. You know, so here we are at the 29th. We're now doing trading a smaller account. Oh, this must have been a different day. Up next is James Boyd talking trading with technical indicators. If you have never heard James teach, you're in for a treat. He's really, really awesome. Tomorrow, I'll be doing Getting Started with Technical Analysis, like I said, at 2 o'clock Eastern. I invite you to join me for that. And so if there's a coach that you love the way they teach, you can just like scroll down and say, Kevin Horner, like what's he teaching this week? And, you know, you can just scroll down and see he's got something on the go every day. So yeah, this is a really nice resource. Okay, so to wrap things up, if you haven't subscribed to the Trader Talks channel, you'll want to do that. If you would do me a favor and hit like, what this does is it moves it up in the trading algorithm so that more people can find this content. We did 3 trades today, just to review, because when there's a survey, and there is no survey today, so you're off the hook. But one of the things that I'm often asked is, would you please review the trades we placed? So we did a trade on JP Morgan. We did one on Citibank, and we also did one on Walmart, which hasn't filled. So, and it's sitting, so maybe we just move it down by a penny to try and get it to fill. And then if you wanted to look at another practice opportunity, I'll make sure that one fills. You might want to look at, it's another financial stock, there we go, Goldman Sachs. And again, uptrending stock, uptrending sector, it's come back to a similar support level. So could we sell something below that, like maybe around the 900 mark? And we don't have time to put that example trade in today, but I'll put that in after the class and then we can follow up. Okay. So guys, thank you so much for joining me today. Huge thank you to Kevin Horner for his work in the chat, and to the guys behind the scenes for pulling this together and making this all work. Again, if you aren't following us on X, Barb Armstrong CS, Kevin Horner CS, I'm also now debuting on LinkedIn, so you can find me on LinkedIn as well. And you know what? I'll post my handle for that on X. So guys, have a really awesome day. Stay tuned for James Boyd coming up next.